All right, I was just going to wait maybe 60 or 90 seconds before we get started. Okay, good morning, everyone. My name is Aaron Lenkowski with Altfest Personal Wealth Management. For those of you who do not know us, Altfest has been at the forefront of comprehensive wealth management for the dental community for about 36 years. This is actually our 10th year anniversary of being endorsed, the endorsed wealth management provider of the New York State Dental Association's members. So we've spent the past few weeks with our clients, your colleagues, walking through what seemed to be one impossible situation popping up after another. As the crisis continues to unfold, we realize that there's a lot of assistance as well as opportunity in the legislation we'll discuss today. I'd like to thank the New York State Dental Association for helping us spread the word and allowing its membership to join us this morning, as well as the Greater Long Island Dental Meeting, Queens, Nassau, Suffolk, and New York County Dental Societies for also helping us invite their membership, as well as the 9th District Dental Association, who also lent a big hand too. Thank you very much. Just some quick housekeeping before I introduce our presenters. We're going to have approximately 30 minutes of content followed by a question and answer period. There is a private chat window to the right-hand side of your screen. I believe it should have populated. It's a private window. It goes to myself and the presenters. If you have a question during any point in the webinar, feel free to type it to us, and we will likely answer it during Q&A. If we don't get to your question, that's okay. We will be able to have one of our representatives email you directly sometime after the event, and we will get to answer those questions. So I'd like to introduce our speakers today, Ekta Patel and Ryan Graham. Ekta is a director at Altfest Personal Wealth Management. She spent 19 years helping clients answer the most pressing questions about their finances. Among many leadership responsibilities at the firm, Ekta has been essential in putting together this presentation we have for you today. Ryan Graham is a senior financial advisor with Altfest. Ryan is also helped in our firm's understanding of all the new local, state, and federal legislation and helped put together the presentation for us. So I want to thank Ekta and Ryan for dedicating their time. And thank you, everyone, for taking time out of your day, logging in and listening to the webinar. I hope you enjoy it. So I'm going to turn it over to Ekta and Ryan now.
Thank you, Aaron. Good morning, everyone. Thank you for taking time to join us this morning. As Aaron mentioned, there is a lot to cover today, so we're going to just jump into what we have for you today. Now, our goal is really to familiarize you with this truly historic $2 trillion stimulus package that was passed a number of weeks ago called the CARES Act, which really stands for Coronavirus Aid, Relief, and Stimulus Act. So at this point, just to give you a little bit of a briefing, I'm going to cover CARES Act in relation to individuals, and I'll turn it over to Ryan for covering CARES Act for small businesses. And then we will conclude the presentation portion of this, talking about investment landscape, and finally take questions and answers. So let's jump into the first part of the CARES Act for individuals. As most of you have heard about this, there has been a number of tax relief. So first I'll go through this, then highlight some of the key provisions of this area. I also want to highlight retirement plan distribution provisions made, as well as suspension of the required minimum distributions and some considerations around that. So those are just to give you an idea what I will be going over. So the first part is the tax-related relief. So by now, most of you have heard that the payment for federal tax filing has been extended to July 15th. And most states have followed that suit as well. And this extension also includes the first quarter estimated payments. If you haven't paid it yet, you have until July 15th to do so. In a way, you can think about this as that IRS is letting you, keep your money as an interest-free loan for probably about 3 months or so. Now, you also have this window if you've not made your 2019 retirement plan distributions or your health saving account. So this window has been extended for a number of provisions. The other part of this is the recovery rebates. A number of Americans have also started getting this recovery rebates. This is what's been talked a lot about in news. It's really an advanced refundable credit for your 2020 taxes. So you can collect that right now, as opposed to when you file your taxes in 2020. This is about $1,200 if you're filing as a single person, or $2,400 if you're filing married jointly. And if you do have kids, qualifying kids, which means 17 or under, that has been increased to $500 per child. Now, keep in mind that there are adjusted gross income AGI thresholds to receiving this. For instance, if you're single, that threshold is 75,000 of AGI, and it phases out after that. Now, how does IRS determine that you should get this? They look at your latest tax return. So if you did file your 2019 return, they'll refer to it for your AGIs. Otherwise, they'll look at your 2018 return to do so. Now, no action necessary really to get this. IRS knows have you paid your taxes. If you wrote checks, they'll send you a check. And if you used your direct deposit, they will deposit in your bank account. Keep in mind that there is no need to pay back this credit if your 2020 AGI at the end of the year happened to be more than the AGI mentioned or referenced in this payout. So for example, if you are a single person made for 70,000 in 2019, you're eligible to receive 1,200. But then in 2020, if you made 110,000, technically you won't be eligible for this credit, but it is our understanding that you do not have to pay this back. The biggest impact probably the policymakers wanted to make through this act was probably through unemployment, expanding the unemployment benefits. So here, the unemployment benefits have been added. It's about an additional $600 per week until July 31st, and that has started April 5th. If you have already exhausted your 26 weeks of unemployment benefits by July 1st, then what that does is that you can apply for additional 13 weeks of that. Also, the temporary benefits, unemployment benefits, have been extended to people who are independent workers or contractors or self-employed that traditionally hasn't been covered under unemployment. So they are eligible for some of those benefits as well. Students are also being covered in some of these reliefs. So for example, if you have a federal student loan, the payments are automatically suspended until September 30th. So you do not have to do anything, they're just suspended. Also, the interest will not accrue in this period. So up till September 30th, there will be no interest on this. Now keep in mind that with student loans, there are different types of student loans. So not all loans are covered under this provision. So for example, private loans, student loans are not covered under this provision. And finally, for student loans, if your employer is assisting you in any meaningful way for paying these loans, technically it's considered as taxable income, but under the CARES Act, up to $5,250 of this loan repayment assistance will be excluded from your taxable income. So that might be somewhat helpful to think about. The next provision has been made in a charitable contributions area. This probably is not a huge deal, but it's just trying to cover as many Americans as potentially the government can, and also sort of encouraging people to contribute, especially in the recessionary environment when charities do not receive as much of funding. So for instance, charitable donations, when you file your taxes, now this can get a little technical, so if you don't understand, don't worry, you can shoot us the questions and we'll be happy to field it after the presentation. But traditionally, charitable deductions are to be itemized. And what the Congress intended to do here is they said that you can take up to $300 in cash donation in deduction, even if you do not itemize your taxes. And keep in mind, most Americans these days do not itemize their taxes, so this is a small benefit that everybody would get. This is donations in cash, not in kind, and it is only to be made to the qualifying charities. So you cannot make this donation to private foundations or donor advised funds, etc. The other interesting thing in this act with charitable contributions is that there is no adjusted gross income limitations applied in 2020. So in terms of how much charitable cash donations that you can make, you can technically contribute up to your AGI and offset your entire AGI for the year. So for example, if your AGI for 2020 is 100,000, you can technically make a large cash donation up to 100,000 and technically reduce your AGI to 0. So this is an important planning strategy that can be considered in conjunction with your advisor and your tax experts to think about for 2020 if you had intended to make large charitable donations either this year or in the coming years. At medical expenses, that list has been expanded. So for example, your health saving accounts, your flexible saving accounts, they can be used for a number of over-the-counter types of medications. There is a whole list mentioned there. So if you are interested, you can go to the CARES Act Treasury website to get that list. Now, to provide relief to people who are really facing cash flow difficulties, what the CARES Act has done, it gives an opportunity for individuals to access the retirement accounts. And this access is called coronavirus-related distribution, and it's receiving favorable treatment in 2020. And let me walk you through a little bit about that. Now, these distributions are from your retirement accounts, both IRAs and employer-sponsored accounts, or combination of both. That are made in 2020. So this is just for this year. You can withdraw up to 100,000. That's maximum. Now, keep in mind, this is taxable. So anything you withdraw will be subject to taxes. However, the 10% penalty that the withdrawal penalty is taken away, especially for people who are 59 and a half. They used to have a 10% penalty to withdraw anything, and that's taken away. Now, one thing to keep in mind, as I said, that this income is taxable, this distribution is taxable, and by default, what IRS is going to do is split this income over a 3-year period. So let's say you took $30,000, it's going to split it over 3 years, 10,000 each in 2020, 21, and 22. What you could consider, and I was assuming that this distribution is taken for financial difficulty, then what you could consider doing is that arguably 2020 could be a lower tax year. So you may have an opportunity to assume this income in 2020 rather than spreading it over 3 years. Now, keep in mind, this is assuming that your future years are high tax years. So again, there is some planning opportunity around here as to how you want to take this income, should you consider taking a distribution. Also, what governments allowed with this distribution is that you can repay it over a 3-year period. So if you've taken some money and let's say 6 months later you feel like your financial situation is better and you're able to put it back, you have a 3-year period to put it back, whether you do it in a single payment or multiple payment, either is allowed. Just make sure that you amend your tax returns so you do claim the taxes that you paid on this. As I said, these distributions are taxable. And the loans, the taking of borrowing from the employer-sponsored plan has also been expanded. So traditionally, the limit's been about 50,000. They have expanded that to 100,000 or 100% of your vested balance, whichever is lower. And Now, with the employer-sponsored plan, I won't go into too much detail. It's very unique to the organization, so you have to be very careful about reading the details of what are the requirements of borrowing. All plans do not permit the loans, and once they do have a strict payback period. One of them could be that if your job is terminated, you might be required to pay the entire amount back. So just be very careful if you're considering using this option. Certainly talk to your advisors that you've exhausted, if you've exhausted other venues of cash flow before you really apply to this. And the final item that I want to talk about as it pertains to individuals before I turn it over to Ryan is the suspension of required minimum distribution. So this applies to people who are who are required to take distributions from their retirement accounts or who are turning age 72 in this year. What IRS has done is basically told them that you're no longer required to take it for just this year, 2020. Voluntary distributions are allowed, so if you still want to go ahead and do it, feel free to do so. These distributions apply to all different types of IRA, employer-sponsored plans such as 401k, 403b. These are defined contributions plans. If you are taking distribution from your pension account, that you still need to take that. Now, we're already in April, so some people may already have taken the distribution for this year. So there are two mechanisms that would allow them to put it back. One is what I just discussed was coronavirus related distribution. So if you've taken it and you can prove that you're impacted by COVID-19, whether you personally had the virus or you're quarantined or laid off, furloughed, or taking care of a child who's home from school, all these reasons are applicable under coronavirus related distribution. So if you've already taken it, you can use that mechanism to put it back either in one single payment or over a 3-year period. The other mechanism to do it is called 60-day rollover period. This has always been around. It's not unique to this act. In this particular area, you can roll over one distribution in a 12-month period, only one. So if you've taken multiple distributions, you're only allowed to roll back one of them. If you intend to put the entire amount of your distributions that you've taken, make sure that you withheld taxes from it. So you will be required to put that out of pocket should you wish to put the full amount in there. Now, when you take a distribution from your retirement accounts, a 1099-R is issued at the end of the year. So make sure your accountant knows that you paid it back so they can account it properly in your taxes. There is the required minimum distribution from your inherited IRA is also suspended, so you're not required to do so. However, if you already taken it, it cannot be reversed. So that is not allowed under the CARES Act. And some things to consider when you are suspending your required minimum distributions. One being that, a lot of people, when they take the distributions from their IRAs, they use it for their cost of living. So just make sure that there are other sources of cash flow income or, cash accounts, pension, etc., that you have it available if you stop this particular cash flow. So something to keep in mind that you should be doing some sort of a cash flow analysis before you choose these options. One benefit to not taking it is that it allows your IRA money to grow for another year or so, especially when we are in a very choppy markets these days. And there are some planning benefits to consider if you really want to suspend your required minimum distribution. So technically, when you take a distribution, it's a taxable income. So if you don't take it, you are possibly in a lower taxable income year this year. And that opens up a door to certain planning strategies. And one of them that we've been actively considering with our clients is Roth conversion. So just to give you a very high level idea about Roth conversion is, you can take in the year like this, when you're not required to take distribution, you can take some money, let's say $20,000 from your traditional IRA. Now that is taxable, so you'll have to pay taxes on it. You can take that $20,000 and put it in a Roth IRA account. Now what that does is Roth, it grows tax deferred in the Roth account like it does in traditional IRA as well. But when you're ready to take the distributions, or if you do need to take a distribution of the Roth account, let's say 5-10 years from now, that is not taxable to you. So not only it grows tax-free, but when you take it out, it is not taxable. And this particular technique can really be beneficial for long-term retirement planning, cash flow planning, and also in some cases estate and legacy planning. But it's very unique to each person's. There are a number of things to consider before you decide to do Roth conversion. So we recommend that you speak to an advisor and your accountant to talk about Roth conversion before you consider that. Or with that, I would turn it over to Ryan.
Great, thank you, Ekta, for that excellent summary. So today, the focus that we'll be placing on the CARES Act for small businesses will mainly be around the Paycheck Protection Program, or PPP, and the Economic Injury Disaster Loans, or EIDLs. So we'll be talking about some key considerations and opportunities in relation to these, as well as how they interact with different tax credits and deferral available to you. And we'll briefly mention some things on the state relief programs out there. Before I dive in, I did want to mention that your individual circumstances will drive your decision-making and strategy around these programs. So what I speak about today and some strategies and considerations may or may not be relevant to you. And if you'd like to understand better how these impact you, you can feel free to reach out to our firm. Our relationship with NISDA means that you are eligible for a 30-minute consultation with us, complimentary. So please don't hesitate to reach out, and we'll provide more details on that towards the end of this call. Before I dive into the content, we're going to bring up one poll question as we want to get an understanding about what you all are doing right now. So we're going to give it about 10 seconds for you to answer this poll question. Please do answer it. The results will be sent to me so I can get a better understanding of where I should place the most focus on this call. So please do just take a few more seconds to answer this poll. We won't leave it open too long, just for the sake of time. So why don't we go ahead and yep. So we have some poll results there as well. So thank you for sharing that. We'll be spending some time on all of these, basically both of these programs. So I'm going to go ahead and start. Hopefully you can see my screen. I was getting out of it there. I'm going to move on to the next slide, which gives you a very broad overview of the differences between the Paycheck Protection Program and the Economic Injury Disaster Loans. So who is eligible? Very likely all of you as dental practitioners are eligible, because most of you are small businesses or sole proprietors or independent contractors. This is the requirement for both the PPP and the EIDL. So you'll be hearing me say EIDL, PPP, just to kind of ease the flow and not have to repeat those long terms. As far as collateral and personal guarantees, this is where the PPP has a big win over the EIDL. There are no collateral or personal guarantees with the PPP. Meanwhile, the EIDL does require collateral if you're borrowing more than $25,000, and it does require a personal guarantee if you're borrowing more than $200,000. So the collateral would be business assets. I just want to make that clear. As far as a maximum loan, many of you may know by now the PPP allows for a loan that is up to 2.5 times your average monthly payroll, or $10 million. So it is very likely that it would simply be the 2.5 times average monthly payroll. The $10 million is usually much above that. The EIDL allows for a loan of up to $2 million. It is possible that you'd be able to qualify for a larger loan through the EIDL than you would be through the PPP. So this is a consideration for you if you need more cash than the PPP can provide. The terms of the PPP are very favorable. There's a 1% interest rate, a 2-year term, and you do not have to make any payments for the first 6 months, but interest does accrue during that 6 months. Similarly, interest accrues during the 1-year deferral period available through the EIDL. There is a longer maximum term through the EIDL of 30 years, and the interest rate is still competitive but higher at 3.75% for businesses. And when can you apply? So the PPP, as many of you have probably seen in the news, has officially run out of money as of yesterday. It is, quote, likely that the government will provide additional funds if they can get an agreement as to the amount and as well as what else will be attached to that additional funding. So as of right now, it seems that applications are paused for the PPP. Hopefully will reopen. Technically, they would be open until June 30th. The EIDL does have a much longer period of time that you'd be available to apply for. So that is until December 16th of this year. And where can you apply? I'm sure some of you have been having some difficulties potentially with applying for these programs. For the PPP, you would be going through a bank that is approved to give 7A loans. We've been saying that it's best that you start with the bank you may have an existing relationship with, because most banks are prioritizing their existing business customers. With the EIDL, you apply through the SBA website. And really, I just want to mention that for both of these programs, you should go in with a nice dose of patience, because we have seen in the past the SBA called the DMV of finance. So you need to be patient with these application process and be diligent in your follow-up to make sure everything is getting processed properly. As far as forgiveness, this is the big helicopter money portion of the act that gets all the headlines. The PPP allows for potentially full forgiveness of the loan if used for qualified expenses, which we'll detail a little bit more. The EIDL, meanwhile, does provide an emergency advance that is forgivable. The $10,000 is essentially free money to you. However, if you subsequently apply for the PPP and accept the loan, that $10,000 would reduce any amount that is eligible for forgiveness through the PPP. So if you get a PPP loan of, for example, $150,000, and you also accepted the EIDL advance of $10,000, the maximum forgivable portion of that PPP loan would be $140,000, which is $10,000 less than that $150,000 loan you may have received. As far as refinancing debt, the EIDL does not allow for this. The PPP only does allow for this if you are refinancing an existing EIDL loan, which is something you can do, and I'll explain a little bit further. I want to mention some key considerations when we're discussing the PPP especially. As you may already know, the amount of forgiveness is based on the first 8 weeks of expenses following when the money hits your account. So the clock starts immediately when you receive the funds. The amount of forgiveness does depend on whether you employ the same number of people compared to a prior period, as well as if you cut wages, that does impact the amount eligible for forgiveness. There's an exception to the employ less people contingency that we'll review in the coming slides. As far as eligible expenses for forgiveness, payroll is the big one. At least 75% must be spent on payroll in order for this loan to be forgiven. Other expenses include rent, mortgage interest, utilities. Utilities would include things like phone bill, internet, those types of things. As far as payroll that's eligible for forgiveness, this is capped at $100,000 of cash compensation per an employee. But this is important to note before you consider other forms of compensation, such as the health insurance, 401k contributions and matches, other kind of periphery items that are in addition to the $100,000 would be considered here. A big part of this loan that is a big benefit for those of you interested in applying if they open it up again, as well as those of you who have already applied, it is non-taxable. So this amount, if and when forgiven for you, is not taxable to you. What is still unclear is whether you can continue to deduct the expenses that you will be getting essentially forgiven through the loan. So all that payroll that you're paying and eventually getting forgiven, can you still deduct it against your income for the year? Further guidance is needed there. A few other considerations I want to make clear, because things have been unclear since the outset for this program, is that independent contractors are not included in the determination of payroll. So once again, they are not included because they themselves are eligible for this program by themselves. So the government does not want any double dipping when it comes to these benefits. For those of you with S Corps, all wages that are paid through the S Corp, including those to you, are eligible as part of this average monthly payroll calculation. However, any net profits that are distributed, those are not eligible to be included in this calculation for the loan amount. A couple things I think that are important to stress here as well. There will likely be audits with this program. So we've seen lawyers recommend that you establish a separate bank account for the funds that you are receiving through this loan and use that bank account to pay for all eligible expenses. This will make things very clean. If and when you do get audited, that it was very clear that you use the loan proceeds for what they were meant to be used for forgiveness. So that is a recommendation. As far as the certification that you're making when applying for the loan, you're basically saying that the current economic uncertainty makes the loan necessary to support your operations. This is something you just want to be mindful of and be comfortable with signing off on. And so we encourage you to think about that and discuss with your counsel if necessary. As far as opportunities, one thing that we've seen as a misconception out there is that you cannot have both an EIDL and PPP loan. That is actually not true. So you can have both an EIDL and PPP loan, with the key asterisk being that you do not use these for the same expenses. So for example, payroll, you cannot use both for payroll. If you did apply for and receive an EIDL loan and used it for payroll and subsequently qualified for a PPP loan, you could simply refinance that EIDL loan into the PPP. So it's not like you're out of luck. You can still do that. So some of your practices may have also already reduced staff headcount. So all in all, this is okay and may even be to your benefit. So if you've already reduced staff, that does not mean you won't qualify for full forgiveness necessarily of the loan you're receiving through PPP. So we're assuming, importantly, that all staff are hired back by June 30th. So that is the requirement in order to qualify for full forgiveness, is that your staff need to be hired back by June 30th. So one strategy we've seen dentists and other professionals using is really, first off, applying for the PPP, so getting a loan. That's kind of the most important thing. And so hopefully there will be additional funding that you'll be able to do this if you have not done so already. Once you do receive approval, or funding status is what it is called, then to the extent possible with your bank, you may want to push the loan closure back as far as you can. And additional guidance by the SBA has been issued that this loan, after approval, cannot be pushed back more than 10 days following loan closure. So the reason you may choose to delay the clock essentially on the 8-week period for forgiveness is that right now, all of you are probably in mandatory shutdown mode essentially, except for emergencies, and you're not paying your people to produce. So to the extent this loan can be used to pay your employees to actually work, that would be the best situation. And so the further you can delay and get closer to when you're actually getting back to work, the better. And once again, the huge contingency there is that you do need to hire back all employees by June 30th in order to qualify for that forgiveness. I want to mention some of these other credits and deferrals out there, and there has also been a lot of confusion, so we want to simplify this for you. The employee retention credit, which essentially is worth $5,000 per an employee. It's 50% of $10,000 of wages for each employee for this year. So it's essentially $5,000 per person. This is not available to you if you accept either an EIDL or PPP loan. So once again, not available unless there's further guidance issued that makes it clear that you could use this after exhausting funds from either the PPP or the EIDL. This could be a good option for those of you who have not applied for the PPP loan, decided not to, or did not qualify or have not done so already. This could be a good option for you to save you on payroll costs when you are back up and running. And even for some, this, especially for businesses with a number of low wage employees, which may not be your business, this could make better financial sense than the PPP in some situations. So it's important to note that. For the payroll tax deferral, you've probably seen this in the news. It would allow you to essentially delay paying any taxes on the Social Security tax portion of your payroll tax for essentially 2 years. So 50% you would wait to pay until the end of 2021, and the other 50% you could wait to pay until the end of 2022. Important to note is that this is a delay. It is not an elimination of tax. You're just delaying when you pay it. And this is available to you if you are applying for an EIDL loan, but it is not available to you if you are having a portion of your PPP loan forgiven. So if you are applying for a PPP loan and it is not being forgiven, then you would still be eligible for this provision. However, if you are having it forgiven in any portion, then you are not eligible for this provision. One tax credit that isn't discussed too often out there is the paid sick leave and family leave payroll tax credit. This credit is available to you even if you are accepting a PPP or EIDL. But important to note once again is that the IRS does not like double dipping. So you cannot use this credit for the same payroll tax or payroll expenses that you're using the other loans for. There is no double dipping allowed. This is essentially a 100% refundable credit. There are some limitations on time periods. The type of employees that are eligible for this credit include those that are forced to stay home to take care of their children because their children can't go to school, those that have been affected by the coronavirus who are in quarantine. The IRS has a very good FAQ online that I'd recommend you check out if you have questions on this payroll tax credit. Unlike the SBA, it's very, very detailed, a number of frequently asked questions on the IRS website that you can take a look at. Finally, I did want to mention briefly that there were some grant programs and loan programs through New York City if you are in the New York City area. As of now, New York has paused the acceptance of new applications for these relief programs, but it may be worth keeping an eye out for these if and when they open up again. So now I'm going to actually pass it over to Ekta again before we wrap up. She's going to discuss a couple opportunities out there in the investment world. So Ekta, go ahead.
Thanks, Ryan. That was very helpful. We've been asked, we've been fielding actually a lot of questions and asked for insights into what we think about the markets, which have been quite volatile over the last 6-week period. And one of them being, are they cheap? Are they expensive? Or can they get cheaper, for instance? And obviously, what do we see and where do we see the markets going and where do we see the opportunities? So I wanted to show you one chart which gives you some sense of where the markets are currently. So this particular chart illustrates S&P 500 valuations, and the valuation matrix is just PE, which is price to earnings. So you take price per share divided by earnings per share, and that's what we get. Now, on average, the S&P earnings has been a 25-year average. So we're looking from 1995 till now, and the 25-year average, if you follow the red dot there, has been for S&P about 16.33 times. So that's been how S&P, where S&P has been on average. And the gray line tells you, generally speaking, throughout during that period where the S&P really, during each year or each crisis that has been. If you look at 2009, S&P's earnings dropped all the way down to P ratios were about 10 times. It got quite cheaper when you look at this 25-year average. Then it moved up, and at the end of 2019, you could see they were as close to about 20 times, right? Pretty close to 20 times. And then we saw the recent drop. So let's focus on just last year. Okay, what happened here? Last year, we started on, if you look at March 31st, 2020, we are at 15.4. But a year ago, we were lower than that. In 2018 and fall, markets dropped significantly. So at the beginning of last year, we felt that the markets were at least fairly priced. So what happened after that? There was a big jump. The PEs went from almost 14 times to 20 times in just one year period. So what happened in 2019? What happened was the price of the stocks kept on going up. And usually when the price goes up and they're supported by the earnings that the companies are producing, the revenues and the earnings, then it's justifiable why the stocks are going up. But last year, essentially what happened for the most part, the price kept on going up, but there was no growth in earnings. The earnings went up maybe marginally or did not grow at all. So just because of that, all the gain that came in 2019 was from momentum on the stock price. There was no real value added with the earnings. The earnings were not growing. So that, in our opinion, made towards the end of last year stock market very, very expensive. And that sort of, had us revisit our strategy to make our portfolios defensive in the event that there will be pullback, which we thought there will be. Certainly, we didn't know that coronavirus would act as a catalyst in a way for that pullback. But it did, and it did it quickly. Very, very quickly, the markets pulled back significantly. And today they are about at 15.4 times PE. So they're not necessarily, we don't particularly think the markets are cheap. Perhaps they are fairly priced. So something to think about. And again, unless we are very optimistic about the future, we don't necessarily think that, the stocks are cheap right now. So to keep in mind where we think markets are, they're probably fairly priced, and we expect more volatility continuing because there has been still, there's a lot of uncertainty as to how the virus will continue, when we would have any cure or vaccine that is effective. So there might be periods where, rolling periods of this as well. So there are a lot of uncertainty that's driving the markets. It's important that you don't just look at one number and feel that, markets have come back and that might be cheaper. Where do we see value given that the markets have come back significantly? All around the world, everything has pulled back because this coronavirus is pretty affected every economy pretty in the same way, in a pretty linear fashion, if you think about it. Now, this chart again gives you a 25 average year range of different economies. So on the left, you'll see US. Then you have developed markets, which includes Europe, US, Japan, Australia, and so forth. Then just Europe, and then Japan. The purple bar there gives you where the average PE has been. And the blue diamond is where we are currently are in terms of where we think the market valuations are. So on average, currently we are below the average valuations of the stock market, pretty much every developed part of the world. And it's somewhat similar in emerging and developing markets as well. But if we look at a different matrix, which is price to book, which is probably very valuable in the way we look at the markets, emerging markets, the right bar, shows that they are they've taken quite a bit of a punch, and they look somewhat inexpensive to us. That doesn't mean that they're not going to be volatile under these circumstances. They are going to be volatile, but we feel that given where they are and given over the last number of years. They've managed their debt well, particularly Southeast Asia, which is have a relatively low debt. And they've done a very good job also in combating this coronavirus. We feel that there might be an area of opportunity to be looking very closely. Certainly there will be volatility, as I said, but emerging markets in Southeast Asia look interesting to us. Also, oil prices have come down significantly, so that's one of the areas that looks significantly attractive to us. Again, oil, we have to see where it is and the recovery of the economy around it, how quickly we go back to normal will push the oil prices. But if you look a little bit out there long term, maybe 3 or 5 years out there, some of these areas would have been a good, we would find that they would have been a good opportunity to invest in at this point. In bonds, not everything looks attractive, especially corporate bonds and longer term bonds are the areas that we are concerned about at this point. So we feel that it's time for you to look at your portfolio very, very carefully and reallocate it accordingly. Again, the markets are not cheap, but there are a lot of different factors given the uncertainty that's impacting the markets. And at the same time, there are certain inherent risks, like in bonds and so on and so forth, that we think people should be looking at their portfolio very closely to reallocate them at this point. With this, I would like to wrap up the presentation. Both Ryan and I thank you a lot for taking time to hear us out. If you do have specific questions, we are ready to take it. So with that, I'll turn it over to Aaron for questions.
Yeah, and actually, I think we're going to do one last poll question before we get into the Q&A, and I'll be reviewing some of those questions here momentarily. So for the final poll question, which I want to emphasize will not be shared with anyone, it's for internal use only. We understand that some of you may have your own personal specific questions and concerns. So we want to understand what's important to you right now. So the poll question should be up. So the first part of this question is just getting a feel for what your biggest financial concerns are right now for the intermediate term. So we'll give it a few seconds on that. And then we'll be moving on to another poll question here shortly, which essentially, I know most of you are all practitioners on this call, and if you would like to speak to us, if you'd like to speak to a representative at Altfest, feel free to put your best contact information, such as phone number, into the chat section so that we can have this, and an advisor or someone else at our firm will be reaching out to you next week. So please do answer this next question as you wish, and feel free to enter in any contact information if you'd like to in the chat section. So, and I think as we wrap up that, I think Aaron, you may have some questions for us if you'd like to start asking those.
Okay.
Aaron, I'm not sure.
So can you hear me?
Yeah, no problem.
Okay. Great presentation. Thanks, Ryan and Ekta. A couple questions here from the audience. Some of this stuff we may have covered in a little bit of detail throughout the presentation. A lot of good information there. So there is a question regarding if we applied for both the PPP and the EIDL, could we use the EIDL for paying other expenses not related to payroll, rent, utilities? Does it still reduce the amount I can use in my PPP?
Yes, great question. Yes, you can use the EIDL for other expenses to the extent you have those. And I believe the answer is yes, that it would still reduce the amount eligible for forgiveness through the PPP. So they are not allowing those of you who did apply for the EIDL and subsequently qualified for the PPP to get an additional benefit over and beyond somebody that would have just only applied for the PPP. So you can confirm with your bank and the SBA, but that is currently our understanding of how this is written, that any amount that is received through EIDL through the emergency grant reduces the PPP loan regardless of how the expenses, what expenses you're spending those on.
Okay, great. There's a participant that wanted some general comments about the NOL program, which I know you know a little bit about there.
Yeah, I can just speak briefly. So net operating losses, which may not apply to most of you, is my assumption. These were severely limited by the Tax Cuts and Jobs Act when that was essentially passed. And now with this recent CARES Act, they have loosened the reins a little bit on what you're able to claim as a tax credit or refund for past operating or current operating losses. So if you're operating at a loss, you can essentially apply those to prior years and get a refund based on the fact that you paid taxes in prior years. So if you're finding yourself in this type of situation, it is something to familiarize yourself with. While normally in the past you may have not operated at a loss, this is something that could be applicable to you.
Okay, great. Another question. Dentist has not yet submitted for a PPP loan application. They're currently practicing in Manhattan. They don't know when the office is going to reopen, but what would be the recommendation for applying now? Let's assume that maybe Congress supports a new package. What would be your thoughts on that is the question.
Yeah. That's a fantastic question. There's probably no right answer necessarily. Assuming Congress does pass additional funding, based on the speed at which the funding did dry up over the past couple weeks, it's probably a good assumption to make that this will also go fast. So you are kind of taking a risk by waiting to apply if and when there is additional funding. In a way, it's great that you will be receiving the funding closer to when eventually things get back up and running, but you are taking the risk that you don't receive the funding. So you need to be comfortable with that risk if you decided to wait and not apply ASAP when there is additional funds approved, if there are.
It's essentially not needs-based, this loan. It's first come, first serve. So it's probably a good idea for you to go ahead and apply it.
Yeah, it's a good question.
Okay. So are S Corp owner employees limited to how much they can claim? The question, the submitter of the question said that they've heard owners of S Corps are limited to about $8,000, approximately $8,000 a month. Is there truth to that?
So I think the $8,000 a month number that you may be getting is maybe approximately the 100,000 cap divided by 12 is where I assume you're getting that number from. I think there are some nuances to the rules for essentially what is a self-employed individual. So there are some nuances that you should be mindful of for if you're filing a Schedule C, if you have an S Corp. And I think at this point, it's not 100% clear whether your $100,000 cap is strictly a cap based on all compensation, including 401k contributions and health insurance premiums that you pay for yourself, or if that's before you include those things specifically for the owner. So I would recommend you speak to your accountant and anyone helping you with the application on that front, because that is another great question, and things are still being ironed out with guidance issued by the SBA.
Okay. So another question pertaining to point in time being funded doesn't mention the actual loan, whether it's PPP or the EIDL, but this practitioner was funded on April 14th. Can they delay using the funds for 10 days, like you've mentioned in the program?
So if I assume by funded, you mean the funds hit your bank account,
Yep.
then I believe the answer would be no. If by funded, you mean your application was approved and the funds have not hit your bank account, then you can speak to your bank to understand if they will deliver the funds later. I think some are choosing to wait to sign off on the loan until that 10th day to actually receive the funds in their bank account. So I would recommend you speak to your bank on that front, because if the funds have hit your bank account, the clock is ticking, is our understanding.
Okay. So if a dentist has received the PPP loan, how long is it? Is it 10 days? How long can you delay bringing the staff back?
Yeah, so this is probably going to be a personal strategy to you all. Because right now, if you've laid off staff, it's likely they're on the beefed up unemployment that Ekta had spoke about earlier. The PPP loan is going to provide for 8 weeks of expenses. And if you don't use up that 8 weeks of expenses, then you're just going to have a loan on your books that you'll have to pay back as a regular loan at a very attractive low interest rate. So if you've already received the funds, in a way, by not hiring employees back yet, you're just increasing the amount of the loan that will just be a regular loan and not forgivable. So if you already received the funds and you still want to wait 4 weeks, that's fine, but there's only now going to be 4 weeks that you're eligible to get forgiveness on of expenses. And the other chunk of the loan will likely just be a loan that you'll need to feel comfortable repaying. So that probably will be dependent on your personal circumstance, on your number of staff, how the numbers really work out in your situation.
Okay. Another question regarding EIDL versus PPP. You had mentioned that during the presentation that you can apply for both. Just want to verify that because it's a question here. One of our attendees, their accountants, had said that you can't apply for both.
Yeah, and this is a great question. So our understanding is that you can still apply for both if it is not used for the same expenses. That being said, we would defer and don't want you to make a decision that's against what your accountant is saying, but you may point your accountant to a number of resources that are clarifying that you can have both loans. So I would carefully investigate that, but that is our understanding right now.
Okay. We have time for a couple of more questions as I'm filing through a list of them. And again, if we don't get to your specific question and answer, we will follow up with a private email. This is a question regarding W-2 versus 1099 income. There's a dentist who had been working as an independent contractor and a W-2 employee. They're currently receiving unemployment benefits, but wondering if it would make more sense to apply for PPP instead of receiving unemployment, because they're considering funds with regards to private loans. Also, if I payroll myself through the PPP, would I be forgiven for those monies? Can you comment on that?
Yeah, that's a good question as well. And I think a lot of it, you will just need to crunch the numbers because it will be dependent on what you paid yourself last year, what you received through 1099 last year, what you received through W-2 last year, what you're collecting on unemployment. Is that superior to what you may be eligible for through the PPP? So I don't think I can give you an exact answer on that front, but just be mindful of how the calculations work and kind of evaluate each of your options.
Okay. I think that's, let me just file back through here, see if we can get to one more quick question. So there's a question regarding the EIDL grant and expecting to receive about $1,000 per employee. Is the sole proprietor considered an employee for this grant money? So I'm
That's a-
assuming
that's
that
a-
means the owner of the practice.
Yeah, so that's a great question. I don't think I can tell you a good answer to that. Our understanding is that the SBA did release guidance that your EIDL grant will be limited to $1,000 per current employee. That was not in the legislation as written, so that seems to be something the SBA decided to do on their own. So some have been very confused by that, and that question is probably best answered by the SBA in your area to determine if you would count or not. It's a great question.
Okay. So we've hit the 12 o'clock mark, ladies and gentlemen. My email address is at the bottom of the screen there. If there are any additional questions that any of you out there have, I'm happy to find answers for you. And certainly the questions that have been submitted through the private chat will be answered via email after the webinar, likely early next week. Again, Ekta, Ryan, thank you very much. Thank you, NISDA, all the participants for joining today. We look forward to seeing you again soon.
Thank you, everyone.
Thank you, everyone. Be well.
Be well.